Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WILLSCOT Holdings Corporation Annual Report. WILLSCOT Holdings Corporation offers a wide range of businesses and services that cater to various industries. At the core of their offerings are modular space solutions, which include office complexes, mobile offices, classrooms, blast-resistant modules, clear-span structures, and sanitation solutions. These temporary spaces can be customized to meet specific needs, making them ideal for construction sites, events, and other applications. In addition to modular space solutions, WILLSCOT also provides portable storage products, such as climate-controlled containers and trailers. This allows customers to store equipment, materials, or even personal belongings safely and securely. The company's product line is extensive, encompassing workstations, furniture, appliances, media packages, power and solar solutions, telematics, connectivity and data solutions, security and protection products, entrance packages, electrical and lighting products, organization and space optimization assets, perimeter solutions, and more. The company serves a diverse range of customers across various markets, including construction and infrastructure, commercial and industrial, energy and natural resources, as well as governments and institutions. With over 75 years of experience in the industry, WILLSCOT Holdings Corporation has established itself as a trusted provider of temporary space solutions and portable storage products. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to significantly drop. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a significant drop in stock price is poor financial performance. This can include declining revenue, increased expenses, or reduced profitability. Companies that fail to meet investor expectations may see their stock prices plummet as investors lose confidence in the company's ability to generate returns. Another factor that could contribute to a decline in stock price is negative news and events. This can include announcements of layoffs, product recalls, or regulatory issues. Such events can damage a company's reputation and erode investor trust, leading to a decrease in stock value. Additionally, changes in the market environment can also impact a company's stock price. Economic downturns, industry disruptions, or shifts in consumer behavior can all contribute to a decline in stock price. Companies that are unable to adapt to these changes may struggle to maintain their stock prices. Lastly, external factors such as mergers and acquisitions, activist investor involvement, or changes in leadership can also impact a company's stock price. These events can create uncertainty and volatility, leading to a decline in stock value. In summary, the decline of a company's stock price is often the result of a combination of internal and external factors. Companies must be proactive in addressing financial performance issues, managing risk, and adapting to changing market conditions to maintain investor confidence and prevent significant declines in their stock prices. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be attributed to several key factors. On the revenue growth side, acquisitions played a significant role in 2025, with the purchase of a regional provider of climate-controlled containers and trailers contributing to increased revenue. Additionally, restructuring efforts through the network optimization plan are expected to reduce annual real estate costs while maintaining market coverage and customer service capabilities. On the other hand, revenue decline can be attributed to various factors. The termination of the merger agreement with WILLSCOT Corp resulted in a significant one-time expense of $180 million paid in 2024. Furthermore, the company's leasing and services revenue experienced a decrease of 6.1% from 2024 to 2025, while sales revenue increased by 4.7%. This decline in leasing and services revenue was likely due to changes in market conditions or customer behavior. Overall, these drivers highlight the importance of strategic decisions and external factors on a company's financial performance. By understanding these drivers, stakeholders can gain valuable insights into the company's growth prospects and make informed decisions accordingly. The net income of the company experienced a decline over the three-year period from 2023 to 2025. In 2024, it decreased by $448,328 compared to the previous year, followed by another decrease of $81,119 in 2025. The most significant drop occurred in 2025, resulting in a net loss of minus $52,990. The profit margins also underwent a decline during this period. The gross profit margin dropped from 56.3% in 2023 to 54.5% in 2024, and further decreased to 51% in 2025. Similarly, the operating income margin declined significantly, falling from 28.5% in 2023 to 11% in 2024, and then to 7.9% in 2025. The reasons behind these changes are multifaceted and attributed to various external factors such as economic downturns, increased competition, credit risk management issues, tariffs, trade tensions, fluctuations in interest rates, labor disputes, immigration laws, commodity price fluctuations, natural disasters, business disruptions, expansion into new markets, governmental regulations, higher labor and raw material costs, fuel cost fluctuations, and potential impairment charges for goodwill and intangible assets. The company is indeed generating positive operating cash flow, a significant improvement from previous years. According to the financial reports, net cash provided by operating activities has increased substantially, reaching $762 million in the current year. This represents a notable increase of $200.3 million compared to the previous year's figure. A closer look at the data reveals that this positive trend is not a one-time anomaly, but rather a consistent pattern. The company's operating cash flow has been steadily increasing over the years, with a significant jump in 2025. In fact, the change from 2024 to 2025 was a substantial $200,341, indicating a strong upward momentum. Overall, these numbers confirm that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. This trend suggests that the company's operations are becoming more efficient and profitable, allowing it to generate significant amounts of cash from its core business activities. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the total indebtedness increased to $3.6 billion as of December 31, 2025, indicating a rise in debt levels. However, upon closer examination, it is observed that long-term debt decreased by 6% from $3.7 billion in 2024 to $3.6 billion in 2025. Furthermore, the ABL facility was reduced from $3.7 billion, suggesting a decrease in short-term debt. In terms of interest expenses, there has been an increase of plus $4,200, 2025 versus 2024, and plus $4.2 million or 1.8% from $227.3 million, 2024, to $231.5 million, 2025. This indicates a rise in interest expenses over the past year. The significant change in interest expenses is attributed to interest rate swaps, which have resulted in a loss of $9.2 million recognized in other comprehensive income in 2025, compared to a gain of $29.3 million in 2024 and $15.9 million in 2023. Overall, while the company's debt level has decreased slightly, the interest expenses have increased significantly due to the impact of interest rate swaps on other comprehensive income. The performance of various segments and regions has been a mixed bag. On the positive side, U.S. and Canadian teams have shown strong results, as have large enterprise accounts and small local businesses. These groups have demonstrated resilience and growth potential. However, other sectors have struggled. The commercial and industrial sector has seen a decline in new contract activations and resulting units on rent, leading to poor performance. Similarly, the construction and infrastructure sector has been negatively impacted by a decrease in non-residential construction square foot starts. Furthermore, the energy and natural resources sector is facing challenges due to potential declines in global or local energy prices, which could significantly affect demand. These disparities highlight the need for targeted strategies to address the unique challenges faced by each segment and region. By understanding these differences, businesses can tailor their approaches to maximize growth and minimize losses. Management's outlook for the company is one of cautious growth and optimization. The primary focus is on increasing lease revenue through volume growth, driving penetration of value-added products and services, VAPS, and optimizing rates. This growth strategy is expected to be achieved safely and frugally. In addition to growing lease revenue, management is also prioritizing capital allocation opportunities, including investing in organic projects, making accretive acquisitions, and returning capital to shareholders. The company has a network optimization plan in place to reduce real estate costs by exiting approximately 665 acres of land over the next 4 years. Management is also committed to sustainability goals, including reducing greenhouse gas emissions and improving energy efficiency. Furthermore, they are actively managing risks, including credit risk, market risk, and operational risk. Overall, management's strategy appears to be centered around safely growing lease revenue, optimizing capital allocation priorities, and implementing cost-saving initiatives. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out quarterly dividends to its investors. This is evident from multiple mentions in various pages of the report. Regarding share buybacks, the company has also been active in this area. It has authorized a $1 billion share repurchase program, demonstrating its commitment to returning value to shareholders through this means as well. There are several concerns that could impact the company's financial performance. One of these is inventory buildup due to misaligned distribution of assets with regional demand. This excess inventory can lead to a material adverse impact on financial performance if not effectively managed. Another concern is the potential influx of units returning from leases, which requires effective remarketing strategies to mitigate any negative effects. The company's supply chain is also vulnerable to disruptions caused by tariffs and trade laws, labor shortages, and increased labor costs. Additionally, fluctuations in interest rates, commodity prices, fuel costs, and raw materials availability can impact the supply chain, further exacerbating potential issues. These concerns highlight the need for careful planning and management to mitigate any adverse effects on financial performance. That concludes the financial summary for WILLSCOT Holdings Corporation. Feel free to comment below, and I will be happy to answer them when possible.